here without the gorilla. He's traveling. And I know, what was it, yesterday? He had the Drips show, and the Drips show is when he comes on and he talks about a lot of the intel that he gets from on high, right? So, for those who don't know, V the Gorilla does a lot of deals on the institutional side when it comes to precious metals, when it comes to cryptocurrency. He's got a company that's set up in actually several different jurisdictions, and if you need to get into or out of, say, precious metals or crypto, he's the guy to talk to. Let me know. I can always put you in touch if he is like the next couple of days you're really that interested and he's not that reachable. Let me know. Make that happen for you. In the meantime, we're going to take a look at markets today. It's going to be a relatively quiet day. There's not a whole lot of data coming through, so it's a good day as long as there's enough volatility, and that's going to be kind of the question. It's a pretty good day to look for some trades, maybe some swing trades. The JPY pairs have actually, in Forex that is, have actually been kind of meh lately. A lot of scammy stuff going on, and I don't mean scammy from the standpoint of the way most people think scammy. I'm talking about from a trading standpoint. A lot of the way that the charts are moving is just not easily tradable, and that's okay. I mean, if you develop an algo, you can trade anything as long as you develop an algo tailored to whatever market you're trading. Okay, so maybe that's what we'll talk about today. We'll talk about low volatility markets. I know I've covered this recently, but we may just end up covering whatever questions come up as opposed to that. We do have some people watching in the private lab, and of course, if you are here on YouTube, you can ask questions in the comment section. Here is a QR code for everybody to come check us out. There is a QR code. You can zap that with your phone, take you to the website, or just go to www.algofactory.tech. The website is right there, and our monthly membership is $50 a month, which is basically nothing. Our competition does not do as much as we do, and they're charging anywhere from, I don't know, $200 to $400 a month. I've recently seen $300 a month, and we are kicking their butt when it comes to what we offer. So come check us out. And towards the end of the program, we will go a little bit more over that. For now, I'm going to turn this off, and I'm going to share my screen. Give me a moment to do that, and we'll start looking at the market. By the way, if you're watching this on YouTube, go ahead, do the like, subscribe, follow, all that kind of stuff. That helps us out. All right. You know the drill. From probably watching YouTube for a few years now. It's amazing. I remember when YouTube was brand new, and it's a whole culture. It's interesting, and I'm not really that involved with the streaming, and I do my thing. I'm kind of not as involved in the marketing side of things. I'm more about just providing the content and leading with that. And there's a lot of tricks to the trade when it comes to doing YouTube and stuff like that. But I guess I'm just old school, man. I'm like, hey, here's what we do, and I hope you like it. So you're looking at a multi-panel screen. We'll come back to that. Don't let that cross your eyes. That looks like some pretty complex stuff. It really is not that complex, just so you know. It's just that my eyes are used to sifting through all that data, and I don't even use all the data on that screen. There's a lot of testing going on. All right. So we did have some pretty big news. The British pound at the European Open at 2 a.m. EST. CPI year over year, and I believe that the CPI came back a little high, just barely higher than expected. And when inflation is high, then the market, the central banks can be expected to not cut rates, right? They need to continue to keep rates elevated so that things slow down in the economy. However, it's barely above expected on both the CPI and the core CPI. That's their inflation metric, which is pretty much the same across the board in most countries, at least most major economies. So that being the case, let's see what the pound did in response to that. Let me see. Let's go to the GBP USD. We're looking at the GBP JPY right there, but we're going to compare the British pound to the US dollar and see what happened. I do see a big wick. So let me expand the screen to make it something we can actually read here. All right, so it looks like there was some action right at the open. I'm going to drop a time frame here because we need to get more granular data. So we're going to look at a 30-minute chart. Okay, so a 30-minute chart is where each of these candlesticks is 30 minutes of price action. And looks like there was actually a pretty good move up in the pound, right? That makes sense, because if the data came out with inflation a little bit higher than normal, then the way to counteract that and slow things down in the economy would be to keep rates a little bit higher, which means the pound would get stronger. So you have this big wick up, but it was blocked, right? It looks like the price reacted to recent structure in the chart. So what that means is before this happened, I'm going to draw a line where this data came out. Okay, so that CPI data came out on that blue line right there. So that is 2 a.m. EST, which I believe is that 7 a.m. GBP, or is it 8? I think it's 8 a.m. I don't, whatever they say now, UTC. We used to call it Greenwich Mean Time, but basically London time. And I think that's 8 a.m. their time. And if you look at some past price action, where price went on this, you're looking at the British pound in terms of the US dollar, right? So as the British pound gains against the dollar, the price goes up and went from like $1.21 to $1.22. And then as it decreases in the dollar, you see the pound go down, back down to $1.21.5. Well, here, price headed up, and then right at that announcement, there was a wick, a strong move up. But you can see here that it made its way up to a prior pivot point. Okay, so what does that mean? Well, price, when was this? On the 17th October, so it was yesterday, in the morning time, price went up to this area, and then it turned back around. So a lot of people were buying the British pound, and then the British pound went up in price, and then here the buyers got tired. They bought what they wanted to buy, and the price no longer became attractive to them. The price started to get too high, so the buyers stopped buying, and the sellers kicked in. And probably some of these buyers here at the bottom started selling at the top. Now, I know that these prices don't seem like there's a big difference. Like, hey, this is just, a few cents. Like, it's only a cent. Well, in Forex, what people are doing is they're using something called leverage to amplify their trades. And their trades are actually, thousands of dollars. And it's Forex, no matter where you are, leverage is always involved. So if you're going to trade something like Forex or anything that has leverage, of course, you're going to want to talk to your licensed investment advisor and, make sure you understand what's going on with that before you start trading, because, you can lose your money in markets. It's just the nature of the beast. And that's why we don't offer any investment advice here. We just talk about the charts from a technical standpoint. And at any rate, so that's why, going up like a cent is a big deal, right? That's the whole story there. So as the price became unattractive, and as some of these buyers at the bottom saw an opportunity to take profit and make some money, they sold. They're like, hey, we bought like 3, 4, 5 hours ago, way down here at like $1.21.3. And the price is all the way up here at $1.22.1. We've made however much money it is, hundreds or even thousands of dollars. And so we're going to take profit. And they start to do that. So buyers become sellers, other sellers come in, buyers stop for a lot of different reasons, and price comes down. And at this area up here, there tends to be a decent amount of price action. And especially right above that area, there tends not to be very much price action. And without getting too far into the way that markets work, whenever you encounter an area that doesn't have a lot of price action, then the large players will move away from that. Large players will sell away from that, or if it's at the bottom here, large players will buy away from that. So that's a dynamic that is a little bit more technical. I don't think I need to explain market maker theory right now. Not at least, if I were to do market maker theory, that would be a whole different class. But what matters is that in these areas, there's probably not a lot of money for the big boys to make, right? So they're going to go ahead and push away from that. And that's what happened here. Well, that never changed. This area up here stayed the same in that respect. So up here, there's not a lot of money for these market makers to make. And there's a prior pivot point. It's where buyers and sellers kind of came to an agreement and things changed. And history repeats itself whenever that happens. So whenever you see pivot points like that, that's when price is probably going to revert and go back to what it did before. And that surely is what happened. Now it could be for one reason or another. Again, we don't know exactly why the price flipped. It's probably a combination of the things that I discussed. It might even be things that I didn't discuss. It's actually, unless you are a very wealthy person and you're spending, $25,000 a month or whatever it is on like a Bloomberg terminal, and you have data that's really, really high level, then you probably will never know exactly why price reverted. But a lot of it's probably just going to be because there's market structure there. It reverted there because it reverted before, right? So that's the one thing you can almost depend on. Now there's times when it doesn't revert, but still that structure is important. Let me go ahead and real quick, I'm going to take a break from the screen. I'm going to put the link for this show into a friendly Discord of ours. So let me do that. That'll take me about 10 seconds. Okay. All right, so now some people can join it if they want to. And we are about halfway through the Beginner Live Lab. So this first 30 minutes of the day for Algo Factory, starting at 8:30 EST, this is intended for beginner traders. We actually open this up. We have traders that come to Algo Factory who they have never traded before. They don't know anything about markets, and we do have some videos to get people kind of pointed in the right direction. Trading is something where you'll probably have to take a lot of initiative, but we answer questions. We have a Telegram channel where you can answer, or you can ask questions, just whatever questions you want, and we'll answer them. Also, our community will answer them. So it's it's a really nice situation there, because you'll get your questions answered one way or another, and we can either point you in the direction to some data, we can provide the data itself, but we are pretty much an all hands on kind of situation there. So if you're a beginner trader, certainly don't be afraid to come talk to us. I know you hear the word algorithm and it's like, oh, scary, and I'm not a computer programmer, and don't worry about that. An algorithm is just a way to trade. It's just a trading method. It doesn't mean you have to have any programming. It doesn't mean you have to program it or anything like that. All right, so commercial's over. Back to the chart. So yeah, we just basically saw a pivot point where it had pivoted prior. Okay, so here you go. And then price now at this point is kind of losing its energy a little bit and starting to consolidate. But at some point, it's probably going to make its way out of this area where it's just bouncing around. That's it has been kind of bouncing around for a while. If you look at this, even that data, even the CPI data, which CPI right now is the hot ticket, and even the CPI couldn't break it out of its range. But what I'm seeing here is a range that kind of looks like this. And it might be tightening, it looked like this. There's some, bottoming out down here, but I might even tighten that range up to like this. And the area of interest for me is going to be when it breaks out of this, initially when it breaks out of this box, and also when it breaks below this area right there. So there are some lower areas to be concerned with, but they're getting older and older and less relevant. There's pivot points back here, but they're still relevant. Price can easily bounce on these and head back up. So what that means is that, in trading Forex and in trading, any kind of derivative or contracts where you can short stocks, it doesn't matter what you trade. If you want to come talk to us at Algo Factory, our methodology works in any market, really, stocks, precious metals, whatever it is. But in this case, we are in Forex and we could go long and short. I have a gold trade. We're going to talk about a gold trade here shortly that I put on yesterday during the show. And I think I put it on during this show for everybody to see. And that gold trade is doing beautifully. We'll take a look at that next. But let me just take a quick look at the charts. I want to see. Let's undo that. All right. I want to take a look at the what my algo says is going on. All right. All right, yeah, kind of a mixed market, but it looks like, yeah, it's super mixed. Look, price is losing kind of steam right now, and it's the general direction is bearish on a higher time frame. However, there is market structure in the way, so it's kind of in this scenario where it wants to head down, but it's losing steam due to conflicting market forces, right? So you have kind of a, there's a consolidation, and it might slow down in this area, and eventually, though, it may make its way down. It's quite possible. So I don't know when this will happen. I don't know if it'll happen. It might end up popping up before it does this. It could go up and then down. It could go up and keep going. I mean, you don't know what happens in the future, right? But what we use market data and indicators, as you saw all that gobbledygook on the screen a moment ago, that, is actually not that big a deal. My eyes know how to decipher it because I've been doing this for a minute. But all that information helps me determine, okay, what may happen in the future, right? And it looks to me like there's going to be a consolidation and eventually price will head down. There's, like I said before, always a chance where price could actually pop up and then head down. But I think down is the future direction eventually. So if that happens, I will probably look for a short on the breakout, and it'll look something like this, where this box that you see is going to depict what my trade probably looks like. And I'm just pretending like it happens like this. It might happen today. I mean, it's not that it's going to happen all the way out here on October 20th. That's in a couple days. It could very well just pop down today. I mean, it's, we're not making a forecast of that manner, but I'm just pretending right now that it is going to consolidate for a few days and then head down. And if it does, that's where I'll probably enter. And it'll probably look like this. And what that means is blue in that green box. That means that I'm going to probably go short right here. I'm going to bet on the price going down. Okay. Right where that line is, right where the blue meets the green, that's going to be my entry in this hypothetical scenario. And then up here where the blue box ends is where, okay, if this trade goes against me, right, and I'm losing money, I'm going to cut my loss. I'm going to get out, right? And then this trade this green box right here is probably what it might go to here. It might go to here. I mean, it just depends, right? But it kind of looks like this is what my trade will be. And the bottom of the green box is where I will exit the trade and profit. Price goes this way. And because of market structure back here, it looks to me like I probably want to get out, before this pivot point. Because like we talked about before, pivot points are where price is probably going to reverse. And this is on a higher time frame. What you're looking at is I've zoomed out. The pivot points we talked about before is this little, like, right here, right? So this little tiny part of the screen is what we talked about before on a pivot point. Well, now that I've zoomed out, going all the way back to the beginning of the month, October 4th, we have a massive pivot point on a much kind of higher time frame. As you zoom out, you see what happened to price on a higher time frame. And I want to get out before that, which is something like this. So now this trade is about a 3-to-1 risk to reward ratio. And again, it's very hypothetical. I haven't really done a lot of precise measurement on it, if you will. So what you're looking at here is a scenario where I could risk $1,000, meaning that if price goes against me and I stop out of the trade, I've lost $1,000 or $100, whatever your number is, right? I'm just using round numbers to, for educational purposes. Now, if price heads down into my profit and gets out, I make $3,070 or $307. So I'm risking a third of what I'm winning. That means I can lose 3 trades in a row and technically still be in profit. Or I should say, let me see, lose 3. Yeah, I can lose 3 trades in a row and then win the 4th and technically be in profit. I basically would be at a break even. But I could lose I could lose a trade and win a trade and be well in a profit. I could lose 2 trades and win a trade and still be well in a profit because I have an asymmetrical scenario, right? I like asymmetrical trades. I like to find trades where I'm risking a small amount, the blue, to win a big amount, the green. Okay, so that's key in trading, and developing an algo to accomplish that is really key. For me, a minimum trade is a 1-to-1. So a 1-to-1 trade is going to look like, I'm going to pretend price is going up in this example. Okay. So just because everybody's used to like buy and sell the old school way, right? So I'm going to pretend that the price goes up. Let's do a better look than that. Let's pretend we have a breakout to the upside. Okay. So my trade might look something like this, where I'm going to bet on the price going up, even though I don't like the term bet, but we'll just say bet, right? So I'll probably would enter right here, and I would have my stop loss down here, where if price goes against me, I'm out of the trade, right? It's like right about here, okay? And then I probably would exit something like right here, maybe. Now this is a 2-to-1, okay? What that means is that if I was risking, say, $100 here, I'm winning 216 because it's 2.16 to 1. So that's asymmetrical. That means my risk is about half of my reward, right? And so if you can develop an algo to accomplish that, then that's the ideal scenario for, anything better than a 1-to-1. Now this, what I just am putting up here, is a 1-to-1. So if I were to go like this, that means that I'm risking as much as I'm winning. Now a 1-to-1 is fine for me. I will take a 1-to-1. I even have algos where I'll take a less than that. I'll have a lot more to lose than I'll win, but I win so many of them that it makes sense. Because there's ways to do that. But in this case, I would say I would lose 1,000 or I would win 1,000. So as long as I'm winning, say, 65% of these, really technically you just have to win 51% or better than 50% to be in profit. But you're not, if you're like winning 51% of these, then you're not making what, $1 per every 2 trades. Like you're just wasting your time. So, I'm winning, if I'm like, say, winning 65% of these, then it's worth it, right? It's worth my time and I'm in profit. So, then that's a whole, now you're talking about a different measurement. In fact, if you look back, I think it's last week, I did a talk on expectancy, which covers this a little bit more. So that's that. And then before we get on to the private lab, we'll go roll over to the gold trade. Okay. I put this gold trade on yesterday, and I think I did it in this show. And it is nicely in profit and just going up. Now, gold has, everything is subject to market shocks, but when it comes to war, gold does well. Okay, so gold tends to go up when there are conflicts. Why is that? Well, gold has, as currency and as wealth, or as at least a storage of wealth, gold has been effective for like 5,000 years. So, no one's questioning whether or not gold has any value. Now, there are times when there's not a lot of return on gold, certainly, so people kind of forget about it or they're not that interested in it, but gold is a big insurance policy. And the way that it's been treated by a lot of private central banks, by a lot of large countries, especially in the East, is that it's going to be a big part of the future, right? So, gold is being bought up. It's the demand for gold is through the roof in real life. There are some, we'll just call it manipulations that are keeping the price of gold low, lower than I think it should be. But, that's, now we're getting into theory. We're going away from charts. Now, when wars break out, as they do in right now the Middle East and even Ukraine, gold will do well, because when wars break out, you don't know what's going to happen in the future, and perhaps the current way of trading goods for services, whatever money you're using, may end up going down, right? So that's like, it might end up no longer usable. Maybe all the countries dump the dollar. You can't use the dollar for trade anymore, that kind of thing, right? So people start to put money into gold, and this big move up is an example of that. And quite frankly, all this move up has to do with Israel, pretty much, going back to the beginning of the month. So, that's what that is. And so I was able to find a nice pullback, and my metrics told me that price was going to continue up. So I went ahead and entered. This is a 2.28 to 1 risk to reward ratio. So that means that if I were to lose $1,000, if I were to lose, I would lose 1,000. If I win and it goes all the way up to my target, then I'm making 2,280. Or let's just say I risked $100, then I would either be losing 100 or making 228. Right, so that's pretty nice. Anything above a 2 to 1 for me is good. Like I said, I'll accept a 1 to 1. And then, I have algorithmic reasons to get out of the trade as well. I have reasons to get out. Price, action does a funny thing, and I don't like where it's going. That's what happens. Okay, so I did draw a line right here. This line was for me to reevaluate the trade, and that line was crossed, I don't know, 5-6 hours ago. It was touched here, actually yesterday in the afternoon, the early evening, my time. And it broke above that. So at this point, if I really wanted to raise my stop loss to 0 to completely take off all my risk, I could. But I want to leave room, a little bit more room for price to kind of move back and forth on this scenario. So basically, price may want to take a break and head back down here and then bounce back up. That can happen. So if I were to raise my stop up to this area, I might get stopped out and lose money, right? So until price makes its way up a little bit higher and I see a decent pullback, I want to see a nice pullback and then a little bit more of a move up. When I see that, I'll be happy to raise the stop. Technically, we got a tiny pullback with this orange kind of candle. Let me zoom in here so y'all can see it. Price did take a little bit of a break right there, right? So I could raise a stop, or I could at least partially raise my stop. Because you can do that if you know what you're doing. But at this point, I'll just wait for a nice pullback. If I see a nice pullback happen and it comes to, like, say here or even here, at least a few candles, and there's a kind of a formation that I like. For those of you in the class, the 5-fingered bogey, probably that whole Bill Williams thing. Then yeah, I would look at raising the stop at that time. So, but for now, nicely in a profit. I'm pretty much at almost a 1 to 1. So the amount that I risked is almost where price is right now. Not quite there, but getting close. So, all right, well, we are now at the end of the show. Again, here's the QR code and the website. So you can see the website here, algofactory.tech. Come check us out. And just as things get crazier and crazier, we had Ukraine, and we had the pandemic, and now we've got Israel, and it's just we're in a time in history where things might continue to escalate instead of calming down. And if you were in the class yesterday, V the Gorilla gave us his drips. He gave us his information that he only gives to Algo Factory members. It's usually 3 times a month or so, sometimes twice a month, sometimes more. But, we kind of wanted it to be once a week, but the information comes when it comes. It's not like, anyway, it's valuable as hell. And I've been following V the Gorilla on his macros since like 2016. So going on 7 years now, and I've been working with him since 2017. So, the guy is very accurate. No one's right all the time, but he's pretty accurate, like scary accurate. So that being the case, what he said yesterday has me thinking that learning how to trade might be not a bad way to go. Because look, I'll tell you something about markets. If markets disappear, then your problem is bigger than not being able to trade, right? If markets disappear, if you can't trade the markets anymore, there's a good chance we're like living in caves. I mean, that's how bad it is, because the wealthy in the world, the elites, if you will, they make their money on markets. That's their transfer of wealth happens through markets. And the wealthy, the elite, they're never going to stop taking money from everybody. And markets is their top way to do it. And I don't think that's going anywhere. So that said, I'm going to hop off here. Like, subscribe, follow, come visit us, algofactory.tech. We love you all, and we'll